This is your technical update from the LMAX Exchange Research and Analytics Desk for Monday, March 7th, 2016. Euro dollar. So the euro has seen a bit of a bounce out from those recent 108.26 lows, with the market trading back towards next key resistance at 110.69. At this point, it would take a break and close back above 110.69 to put the pressure back on the top side, while inability to do so will keep the pressure on the downside for a break back towards 108.26, below which exposes 107.11, the 2016 low further down, which guards against the December base at 105.21 below there. At this point, again, only back above 110.69 would compromise the bearish outlook. Sterling dollar. So cable has seen a nice recovery in recent trade, though the market should now be looking to put in a lower top ahead of a bearish resumption. Overall, the downtrend is firmly intact here, and the market should be poised for a retest of recent lows that we're seeing, those 7-year lows at 38.36, below which exposes a measured move downside objective at 135, which also coincides with the multi-year base from 2009. Dollar yen. So dollar yen is seeing some bearish consolidation over the past several days, and while the market holds below 116, there is risk for additional weakness below the recent multi-month lows at 110.98, which could open the next major downside extension towards a measured move at 107 further down. At this point, a break back above 116 will be required to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has been very well supported on dips ahead of critical support at 107.15, with the market still confined to a broader recovery outlook, favoring an eventual break back above the recent multi-month highs at 112 and towards 115 further up. At this point, only back below 107.15 would compromise the constructive outlook for Euro Swiss. Aussie dollar. So Aussie is traded back into some critical resistance now after taking out some key resistance at 73.85 on Friday. At this point, the market is trading up towards the 70.40 area, which is that next level of medium-term resistance going back to August of 2015. If the market can establish above this level, this would open the door for a potential structural shift and more significant gains in Aussie's favor, but at the same time, inability to hold above 74 in the sessions ahead could open the door for a resumption of declines and suggest we're seeing a more medium-term bearish consolidation ahead of the next major downside extension back towards the recent multi-year base at 68.27. Dollar CAD. So dollar CAD has seen an impressive correction over the past several days, basically going back to January off those near 13-year highs at 146.90. There's risk for additional declines, just a little bit more, towards a key 78.6 fib retracement off of the October 2015 low to January high move, which comes in around 132.30. At that point, this market should be poised for some form of a higher low and resumption of the broader uptrend back towards 146.90. Kiwi dollar. So Kiwi has been trading within a consolidation over the past several weeks, though the market is now trading up towards some critical resistance around 69. At this point, while the market holds below 69, the bearish outlook remains intact, and we can expect to see another stalling out ahead of 69 in favor of the next major downside extension. Ultimately, though, the market will need to establish back below key recent support at 65.46, below which will expose more critical support at 63.47 further down. Again, only back above 69 would compromise the overall bearish outlook for Kiwi, which means that selling rallies in this market would be the preferred strategy. SPX 500. So the S&P 500 is now traded back into a critical ideal lower top zone in the 2000 to 2025 area. The break below the previous August 2015 base several days back has suggested that there's been a major shift in this structure, favoring a topping outlook and deeper setbacks in the weeks and months ahead. As such, this the 2000 to 2025 area should act as the next lower top, which coincides with some key previous support now turn resistance. Look for the market to roll back over in favor of weakness back below the recent multi-month low at 1808 and towards the 1600 area further down. Only a close back above 2050 would really compromise this bearish outlook for the S&P 500. Gold. So gold continues to retain a highly constructive outlook following the recent break back above 1200, and the market is now focused on a retest of the 2015 high from January of 2015 at 1307. At this point, any setback should be very well supported towards 1200, with only a break back below 1192 to compromise the newly adopted constructive outlook for gold.